Welcome to our class, our video class on technical analysis from the Quantitative Methods Applications study session. In terms of technical analysis, there's a lot of detail in the reading that I don't think you'll be held responsible for, but we really need to be familiar with the types of indicators and how some of them are used within technical analysis. So let's start out here talking about some of the principles and assumptions of technical analysis. The idea of technical analysis, which is analysis based really on just trading information, volume and price trend information, or daily values, weekly values, any kind of price and volume data. So the idea is that stock values are determined by supply and demand, which I think we can all agree with, and they're driven by both rational and irrational investor behavior. Now, technical analysis uses these price and trading volumes to analyze change in supply and demand and identify trends that persist for long periods, and trends and patterns that repeat themselves, and they have to repeat themselves in predictable ways for technical analysis to be useful for making your trading decisions. Now, fundamental analysis, which we focus on mostly in the CFA material, look for changes in intrinsic values. So we're trying to see what prices should be, trying to value stocks and find out, or other securities, and find out where they are trading versus where we think the value is, and make trading decisions based on that. Now, with technical analysis, we try to predict price changes through the analysis of the past trading behavior. So what are some of the advantages of technical analysis? Well, the claim is that it's based on actual trade data, whereas fundamental analysis is based on accounting numbers, which can be estimates. Technical analysis can be used for assets with no cash flows to be discounted for valuation. So when we get to something like valuing gold, which has no cash flows for us to discount and no intrinsic value for us to come up with, fundamental analysis. The last topic here for us is intermarket analysis. Now, there's certainly a relationship between bond prices and interest rates, and between interest rates and stock prices. So we may see sometimes a divergence that when bonds go up, it's because interest rates go down, but money moving into bonds may be money not moving into stocks, and vice versa. So intermarket analysis looks at these interrelationships. And these could be equities, bonds, currencies, commodities, all are interrelated. And then we can look at industry groups too, and what's going on with energy versus utilities, or healthcare versus financials, telecom or consumer discretionary spending. And then we can also look at intermarket globally, London versus New York Stock Exchange versus Tokyo, Hong Kong, or Germany. Now, these relative strength charts, and when we're talking about relative strength here, we're talking about the price of, say, an equities index versus a commodities index, or energy versus the S&P, Microsoft versus information technology sector, or perhaps the 10-year Treasury bond versus the S&P 500. So if we're thinking about the 10-year Treasury versus the S&P 500, that will be high when the bond price is high and the equity market is low, and extremes of these tend to indicate inflection points where, after a period of money moving out of equities and into bonds, that switches, and the idea is we get into a longer term trend the other way, where money is moving out of bonds, bonds are falling, and moving into equities, equities are rising. So this relative strength indicator would reach a peak and then go into a prolonged downtrend after that. Well, this is just an overview of some of what's done in technical analysis. I suggest you look specifically at the learning outcome statements to see exactly what you're supposed to know. And most of it we've managed to get in here. About the reversals, about confirmations of trends, about shorter-term moving averages moving through longer-term moving averages, how oscillators are used, and some of the basic chart patterns and charting methods that technical analysts use.